if you look at the aggregate moves from markets over the course of the month, it would appear as if not much was going on. Fairly modest moves across most asset classes, gently going up in most cases. But if you look within that, there was a lot of volatility during the course of the month, particularly in bond markets, where yields moved around quite a lot, mostly in response to expectations from the Federal Reserve, what they were going to do on interest rates, data coming out of the US, that type of thing. The general pattern has been that bond market yields are edging up after that sharp fall post-Brexit. And remember, falling bond yields means you've got a big capital return. Rising bond yields, you're now seeing bond markets coming under a little bit of pressure. And I think that was the sort of broad trend as we went through the month, through this period of volatility. The important thing to say about the Fed, which of course had its meeting in September, was inaction. It didn't move on rates. The market was not really expecting that. But perhaps more importantly was the Fed's statement, which was rather more dovish than the market was anticipating. And perhaps most importantly, what they've indicated is through the course of this year, maximum of only one rate rise is likely now. Remember, a year ago they were talking about 4 rate rises in 2016. They've also ratcheted down their expectations for what's going to happen to rates in both 2017 and 2018 by 0.5% each year. So they're now expecting only 2 rate rises next year, 3 in 2018. So generally speaking, they've ratcheted down their expectations for rate rises. Looser for longer remains the mantra as far as the Fed is concerned, but the market still remains very sensitive to data coming out of the economy. And we've seen, generally speaking, good numbers coming out of the US economy. The labour market, as we know, has been pretty strong and remains pretty strong. So there is an expectation now that the Fed will raise rates, most probably in December. And the market remains a little bit nervous about that. So we are seeing bond yields going up a little bit as we speak. Markets sort of beginning to build in that likelihood of a rate rise. Bank of Japan, at its meeting this month, I think surprised markets. What the Bank of Japan has found is that its move into negative interest rates earlier this year is not having the desired effect. In other words, you've seen a sort of diminishing marginal returns from this further loosening in policy. And indeed, negative interest rates are really damaging banks and insurance companies in particular, and offsetting the benefit of lower rates on asset values and confidence. So the Bank of Japan, in its September meeting, signalled a change in tack. They're still going to maintain a very ultra-loose monetary policy. They're still targeting inflation of 2%. In fact, they've said they want inflation to exceed 2% before they ease off on policy, so they're going to continue to buy assets at very substantial levels. But instead of targeting the quantity of assets they buy, they're now going to target a particular interest rate on 10-year government bonds. So that's a very distinct change in policy. It's designed to help banks in terms of their profitability, but it's also been seen as a bit of a signal that the Bank of Japan is looking towards trying to unwind this extraordinary amount of money it's having to pump into the markets without, at the moment, seeing the desired impact. So I think it was a pretty significant move, and we're now going to be watching very carefully to see what the Bank of England and the European Central Bank do in their forthcoming meetings to see whether they're going to maintain this really ultra-loose policy that they have. We think they will, and indeed we think they probably have to, but it looks to us as if we're now getting a bit of a change in tack, and I think increasingly we're going to be looking towards governments and fiscal stimulus to help to keep economies growing. Commodities really this month were driven by the oil price and OPEC. There had been noises coming out of OPEC. They were moving towards some sort of a curb on production, and we did see the outline of a preliminary agreement in OPEC to curb production, in fact to cut production next year by 1 million barrels a day. Quite significant, because that's about the excess the supply that's in the market at the moment. The devil is in the detail. It's not going to be until the end of November that they will decide on the individual countries' cuts in production, and there's no doubt going to be some difficulty about that. There's probably going to be some difficulty about implementation, but it's a very clear change in direction. It's the first production cut since 2008. It's the first time in this cycle that Saudi Arabia, by far the biggest producer in OPEC, has indicated that it's prepared to curb production. So I think we're seeing a bit of a change going on here too. The oil price reacted very significantly to that. It's up over 10% from the mid-month lows, got back up to above $50 a barrel. It looks to us now as if the oil price could well trade in a range, perhaps mid-40s to mid-50s, something like that. At the top end, capped by the almost certain increase in production from US shale producers, whose production costs have come down very dramatically, and it's probably supported at the bottom end now by clear measures by OPEC to curb production, as well as continuing growth in demand as the global economy continues to grow a little bit. The UK economy has, I think, surprised all those economists and Remain campaigners who, prior to the referendum, were telling us that the UK economy was going into recession, it would fall into a large hole if we voted to come out. In the event, the UK economy has actually accelerated and picked up, done far better than people thought, and all those economists are now revising up their forecasts for growth. Indeed, this year, I think the UK economy is going to be the best performing economy of the top 7 globally. Not big growth, but close to 2% probably, much better than people thought post-Brexit. However, you could argue that at the moment the UK is in a bit of a sweet spot. It's still in the EU, so it's still benefiting from the single market. There's been a big fall in sterling post-Brexit, so parts of the economy, notably manufacturing, are actually doing very well out of the fall in sterling. They're much more competitive. So guess what? The parts of the economy are really growing quite strongly now. As we look into next year, I think things are going to slow down and change a bit. First of all, the Prime Minister, Mrs May, has now announced the likely date for when the UK exercises or invokes Article 50, which triggers the exit process from the EU. That's going to be done before the end of March next year. So we now know the clock is ticking. 2 years from then, we'll be out of the EU. And she's also said, perhaps more significantly, that the government is going to put a bigger emphasis on controlling immigration than worrying about maintaining the entry into the single market. So it's prepared to compromise on single market benefits as long as it gets control over immigration. Now that's raised certain alarm bells in industry saying, well, maybe we're not going to get the sort of access to the single market we want. Maybe there's what people are calling a hard Brexit. It raises uncertainties, perhaps a bit of nervousness, deferring investment decisions. So I think next year the economy is going to be tougher, not falling into a recession because there's good momentum behind the economy. It's certainly a lot tougher, much slower growth, probably through the next couple of years as this long period of negotiation with the EU continues. Beyond that, I think the UK will be absolutely fine, but we've got a tough period here, and sterling has reflected that by coming under quite a bit of pressure, fallen to a new 31-year low against the dollar, for instance. So far this year, it's probably fair to say that most markets have done better than most people thought they would do going into this year. Bond yields have fallen, so capital values have been going up. Equity markets had a terrible start to the year. January and February were very weak. Since then, there's been a really strong return from equity markets. But what that means is that valuations have got to quite high levels in equities to extremely high levels in government bond markets. On the other side of the equation, there are some sort of shorter term uncertainties out there. I've talked about the Fed. The Fed might well raise rates, probably will in December. The market's going to be a bit nervous ahead of that. You've got a little matter of the US presidential election. If Clinton wins, then status quo prevails. The market's probably going to be okay. If Trump wins, there's a sort of new level of uncertainty. Do we really know what Trump will do if he becomes president? So that introduces some shorter term concerns. You've got China, which we all know is battling with too much debt. The economy's done well this year because of stimulus, probably too much dependency on stimulus measures from the government. They've got to be wound back. I think China will come back to cause some issues in markets in due course. We know we've got a banking issue still across much of the EU. We had problems with Deutsche Bank in the last month, for instance. Again, that's it's a problem that's not going to go away quickly. So none of those things are going to be substantive enough to cause a major downturn in markets or a major slowdown in economies, but they could well be enough, given the high valuations of markets, to cause setbacks. So I think it's wise for long-term investors to stay invested in the markets. This cycle has got further to run, but in the short term, I think a degree of caution is warranted.